before we begin, be sure to hit that subscribe button. It is totally free. Give us a thumbs up. We appreciate all the support. So the stock market is very complex. So the point of this video is to educate people on the stock market so they have a better understanding if they're considering investing. So why exactly should you care about what the stock market is? So the stock market is very important to tell about a country's financial stability, how they're doing, how businesses are doing, how growth is doing. In addition, we have a lot of different investments into the stock market, even if we don't trade directly. For example, all of our retirements, 403bs, 401ks, pensions, all of that is wrapped up into stock markets, mutual funds, etc. In this day and age, it's very important to have a financial understanding of the stock markets and ways to invest your money. With the internet, with videos, YouTube, there's a lot of different ways to find financial information. It's recommended that you start early, you learn this stuff, and that you get on that financial grind. There are many publicly traded companies out there like Apple, Disney, Microsoft, McDonald's. These companies are in all different sectors in our lives. And these companies, when they want to gain revenue, they could go public. The higher the stock market is generally a good indication on how our economy is doing. In addition, most of us have 401ks or 403bs or retirements, pensions, and all of that money is generally put into stocks. So banks, retirements, all sorts of financial aspects are tied to the stock markets, both in the US and worldwide. So it's very important that we have an understanding of what the stock market is. So what exactly is the stock market? So the stock market is a place in which people can buy and sell shares of ownership of a publicly traded company. This is known as stock trading. So basically, the stock market is an auction type of situation in which people can buy and sell these stocks based on bids and asks. So the bid is the price that a buyer or an investor is willing to pay for the particular share, and the ask is what sellers want, the people who own the shares. So basically, the two align and trades and deals are worked out constantly during trading hours. So what exactly is Wall Street? Symbolically, Wall Street encompasses the US stock market. This includes banks, hedge funds, mutual funds, stocks, different securities and commodities like oil, etc., that drive the economic system. Literally, Wall Street is an area in New York City, Manhattan, in which there are financial headquarters of a lot of big institutions. This includes the New York Stock Exchange, NASDAQ headquarters, the Federal Reserve Bank, JP Morgan. All different financial institutions are located in this area known as Wall Street in the center of Manhattan in New York City. This is the financial center of the US stock market. So while New York was a Dutch colony, the governor at the time ordered a 10-foot wooden wall to protect the Lower Peninsula from British and Native Americans. This street became known as Wall Street because of that wall. Later, in 1792, New Yorkers that were involved in economics began to develop rules of a financial game, and they created the New York Stock Exchange. So all over the world, there are multiple stock markets. Each market is geared towards certain countries, typically in that region or that country. So within the market, there's sub-exchanges that companies can choose to be traded on. So for example, in the United States, the two major stock exchanges are the New York Stock Exchange and NASDAQ. There's also Amex and a couple other smaller ones that are kind of geared towards cities. The hours and operations of the United States stock market, 9:30 in the morning Eastern Standard Time to 4 p.m. And then they have extended hours, 4 p.m. to 8 p.m. Eastern Standard Time. There are also a couple major stock indicators that we use to determine how the overall United States stock market is doing. Those two indicators are the Dow Jones Industrial Average and the S&P 500 index. Those two stock indexes give us a lot of information about some of our major companies in the United States. The Dow Jones Industrial Average takes the top 30 largest United States blue chip companies like 3M, Apple, Pfizer, Disney, Chevron, etc. The S&P also does something similar, but the S&P 500 is the top 500 companies in the United States. So both of those kind of give an overall average of how the United States companies are doing. So when people refer to the stock market being up or down, they're referring to the Dow Jones and the S&P 500. Now individually, the stock market could be up or down. The Dow could be up, the S&P could be down, but individual stocks can be up or down regardless of the S&P or the Dow. For example, the Dow may be down big on a certain day, but one particular company like Apple might be up. You've probably heard the terms bull and bear markets. Well, a bull market is a market in which the stocks are overall on an uptrend. A bearish market or a bear market is where stocks are overall on a downtrend. Economically, things are not going so well, a recession, a crash, economic depression, that would typically be a bearish market. Now, individual stocks can do well even in a bearish market, and on the flip side, in a bullish market, your individual stocks could do poorly. So what is a stock market crash versus a correction? So a stock market correction is typically when the S&P or the Dow Jones Industrial Average go down and drop probably more than 10% in a particular day. This is typically because it was overinflated and it was too high. A stock market crash is when the market drops 23% or more in one particular day. So some of the more notable US stock market crashes, obviously you have 1929, which was the worst in the US history. You also had 1987, which was a really, really bad stock market crash. You had the early 2000s with the dot-com bust, and then of course 2008 with the Great Recession. So basically picture a stock of a company as sort of a pie. And there's a certain amount of pieces of that pie known as shares. And those shares can be bought for a certain value at that moment. The availability of shares or pieces of that pie is known as the stock float. So if you get your hands on one of those pieces of pie, you own a partial stake in that company technically. So if the company does very well financially, chances are the demand will go up for that piece of pie. If the company does poorly, or if there's bad news, well, then the share may go down. That piece of pie may actually devalue. So how do companies make money on being a publicly traded company? Worldwide companies begin trading with what is called an initial public offering, or IPO. So before the IPO, the company would determine a date and a fair market value price. On the trading day that the IPO is offered, big-time investors begin purchasing and selling trades. So initially, the company gets big investors to directly deposit finances into the company's bank accounts. All the money traded after the initial public offering is between investors and it is based on supply and demand. The company doesn't make any additional money after the initial IPO. So we're going to use Uber as an example of an initial public offering or IPO. So on May 9th, 2019, Uber began to trade publicly. It offered 180 million shares. That means 180 million pieces of that pie. The company determined that $45 a share was fair market value for that point in time. So the company ended up gaining $8.1 billion to use however it pleases off of that IPO. So right now, Uber does not make any money on the stock price. Companies can continue to provide offerings throughout their existence. This is called dilution. So when the stock does another public offering, it's doing the same thing it did. It's giving extra shares out there, adding more shares, more pieces of that pie out there for big investors, and then it can make money again quickly off of that. All right, guys, thank you so much for watching. If you didn't already, hit that subscribe button, give us a thumbs up, and we'll see you guys next time.